Imagine you walk into a giant grocery store with thousands of options. You only need a few things, but the endless choices confuse you. Investing is the same way. The stock market is filled with thousands of companies, and most people overcomplicate the process, trying to pick individual stocks and time the market. But what if I told you that you only need 4 simple ETFs to build wealth and secure your financial future? Today, we're going to make investing as simple as picking your favorite 4 toys from a huge toy store. If you've ever felt overwhelmed by the stock market, this video is for you. We're going to talk about 4 ETFs that do all the hard work for you. No more worrying about picking the right stocks or watching the market every single day. These 4 ETFs are all you need to grow your money and build wealth. So sit back, relax, and let's dive in. First, let's talk about what an ETF is. Imagine you have a big basket filled with different kinds of candy. Instead of choosing just one, you get a mix of all the best flavors in one package. That's exactly how an ETF works. An ETF, or exchange-traded fund, is a collection of many different companies bundled together. Instead of investing in just one company, you invest in hundreds or even thousands at once. This helps lower risk because if one company performs badly, the others help balance it out. Now let's talk about the 4 ETFs that can help you build a strong investment portfolio. These 4 are powerful because they cover everything you need for long-term growth, stability, and passive income. The first ETF you need is the Vanguard S&P 500 ETF, or VOO for short. This ETF is like owning a piece of America's 500 biggest and most successful companies, including Apple, Amazon, Google, and Tesla. Historically, the S&P 500 has delivered an average return of about 10% per year. That means if you invested $10,000 and left it alone, it could grow to over $174,000 in 30 years. The Vanguard S&P 500 fund's low expense ratio of just 0.03% ensures that nearly all your gains stay with you. Because it tracks the S&P 500, it benefits from the long-term growth of the biggest companies in the U.S. Even if some companies fail, others take their place, ensuring steady growth over time. Another great thing about VOO is its strong historical performance. While the stock market does have downturns, the S&P 500 has always bounced back, making VOO a reliable choice for long-term investors. Next, we have the Vanguard Total Stock Market ETF, VTI for short. While VOO focuses on the biggest companies, VTI goes even further by including mid-sized and small businesses that could become the next big thing. This ETF holds over 4,000 companies, making it one of the most diversified investments out there. Some of these smaller companies grow at a faster rate than large ones, giving you more opportunities for higher returns. Historically, VTI has delivered long-term returns similar to VOO, around 10% per year, but with slightly more exposure to fast-growing small-cap stocks. It also has an incredibly low expense ratio of 0.03%, meaning your money continues to work for you with minimal fees. The key advantage of VTI is its exposure to up-and-coming businesses. While some of the larger companies in VOO may have slower growth, VTI allows you to benefit from the rapid expansion of smaller companies. If you want exposure to every part of the U.S. economy and don't want to miss out on future giants, this ETF is a great choice. The third ETF, Invesco QQQ Trust, QQQ for short, is all about high-tech growth. This one focuses on the NASDAQ 100, which means it invests in the top 100 tech and innovation companies. Think of companies like Apple, Microsoft, Nvidia, and Meta. QQQ has outperformed the S&P 500 over the past few decades, delivering annual returns of around 13 to 15%. That means if you had invested $10,000 in QQQ 30 years ago, today it would be worth over $660,000. However, with high growth comes more risk. Tech stocks tend to be more volatile, meaning prices might swing up and down more than traditional stocks. But if you're investing for the long term, the upside potential is massive. QQQ has a slightly higher expense ratio of 0.20%, but given its historical performance, many investors find it worth the cost. What makes QQQ special is that it gives you exposure to the most innovative companies in the world. If you believe that technology will continue to shape the future, investing in QQQ is like betting on the next big breakthroughs in AI, robotics, and software. Finally, we have the Schwab US Dividend Equity ETF, SCHD for short. This one is different because instead of focusing on high growth, it focuses on passive income. SCHD invests in companies that pay dividends, which are cash payments made to investors. Imagine getting paid just for owning stocks. Sounds nice, right? Companies like Coca-Cola, Pepsi, and Home Depot regularly pay dividends. SCHD's dividend yield is around 3.5%, which means for every $10,000 you invest, you earn about $350 per year in passive income. Even better, if you reinvest these dividends, your money will compound over time, accelerating your wealth growth. SCHD also has a low expense ratio of 0.06%, keeping more of your returns in your pocket. Unlike the other ETFs, SCHD is designed to provide you with a steady stream of income, even if the stock market goes through rough times. Many investors use this ETF to create a reliable passive income source that can help cover expenses or reinvest into more shares over time. If you want steady cash flow while still growing your wealth, SCHD is the perfect addition to your portfolio. You might be thinking, why do we need 4 different ETFs instead of just one? It's all about diversification. Remember the candy basket? If one type of candy isn't great, you still have a variety of others to enjoy. The same concept applies to investing. VOO and VTI give you exposure to the entire US stock market. QQQ gives you access to the fastest growing tech companies, and SCHD provides stable dividend income. This mix helps protect your investments from market ups and downs, so you don't have to worry about putting all your money into just one place. Now that you know about these 4 ETFs, the most important thing is patience. Investing is not about getting rich overnight, it's about letting your money grow over the years and decades. Think of it like planting a tree. You start with a tiny seed, and over time, with sunlight and water, it grows into a huge tree. The same happens with your money through compound growth. For example, if you invest just $500 a month into these ETFs and they grow at an average rate of 10% per year, in 30 years, you would have over 1.1 million. The earlier you start, the more time your money has to multiply. That's why long-term investing is the key to financial freedom. What have we learned today? Investing doesn't have to be complicated. You don't need to pick individual stocks, stress over market news, or try to time the perfect moment to buy and sell. All you need are these 4 ETFs, VOO, VTI, QQQ, and SCHD, as well as time. The sooner you start, the better off you'll be. So, if you're ready to take control of your financial future, consider adding these ETFs to your portfolio and let them do the hard work for you. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss out on valuable investing tips. Let me know in the comments. Do you own any of these ETFs? What's your favorite long-term investment strategy? See you in the next video.